Your credit score can impact everything from securing a home loan to getting the best financing on a car or even getting a job. And sometimes building or improving your credit can be overwhelming, but not to worry. I am here to break it down and show you how to boost your credit today. Hey everyone, this is Bola Shokumbi. I'm the founder and CEO of Clever Girl Finance. I'm also the author of the Clever Girl Finance book series, Choosing to Prosper, and my Wealth Plan Workbook. Welcome to Clever Girl Finance TV. So today I'm going to break down simple tips you can take to help you get to the point where you are improving your credit, building credit confidence, and making smart credit decisions, starting with tip number one, which is to know your current score and check your credit report. So, the first step to building credit confidence is knowing where you are right now, knowing what your credit score currently is now, so you know what steps to take. You can craft an action plan to improve or maintain your credit. Your credit score is just one number, but it is based on your entire credit history, which is basically a history of how well you have paid your bills in terms of the credit that you owe to different creditors over time. And this is tracked by your credit report that is created by the major credit bureaus, Experian, TransUnion, and Equifax. And you can get a free copy of your credit report. You are entitled by law to get a free copy of your credit report every year at annualcreditreport.com. You want to make sure that you review your credit reports carefully for errors. There are a lot of errors out there in credit reports. I even read a statistic that states that 1 in 3 credit reports has an error, whether it is an incorrect name spelling, an incorrect address, or even an incorrect amount that you owe to a creditor. So it's really important that when you get your credit report, that you review it in detail for any errors that may be on it. You also want to review it for outdated information and also signs of fraud. So you want to make sure that there are no accounts that are open on your report that you have no knowledge of. Even small errors can impact your credit score. So if anything looks unusual, if anything looks incorrect, you want to report it to the credit bureaus as soon as possible. And you can find out exactly how to make reports or inquiries with each of the bureaus on their direct websites at Equifax.com, TransUnion.com, and Experian.com. Knowing your score and understanding what's on your report will help you get a sense of control because you're going to know what's on your report and what's impacting your score. Number two, you want to pay your bills on time every single time as long as you're able to do that. So, one of the biggest factors that impact your credit score is your payment history. In fact, it impacts up to 35% of your score. And so, it's really important that you are paying your bills on time because they tie directly into your payment history that your bill providers, your servicers, your creditors are reporting to the credit bureaus. Paying your bills on time is one of the simplest and most effective ways to protect and maintain your credit score. If you're someone who struggles to remember due dates, consider setting reminders on your phone, on your calendar, or automate your payments. And if you're struggling with having so many different bill due dates, one thing you can do is call your service providers, call your creditors, and ask them to move your due date. Many of them will oblige this request as long as you're not trying to move it 30 days beyond when that bill is due. So let's say, for example, you would like to get all your bills due around the 15th, but then you have them scattered throughout the month. You can actually call your creditors and ask them to move your bill due date to the 15th, and many of them will oblige to this request. This can make it easier for you to remember when it's time for you to pay those bills. Keep in mind that late payments can have a significant impact on your credit score and can stay on your report for years and set back your score. So you want to be mindful of paying your bills late. If you find that you're in a position where you are unable to pay your bills on time, you cannot pay your bills on time because of an income loss, job loss, etc., changes to your financial situation, pick up your phone and call your creditors, call your service providers, and ask them if there's any way that they can assist you in terms of deferred payment plans, different types of payment plans, grace periods, etc. This way you can have that conversation with them and they can help you come up with a plan as opposed to making negative remarks to the credit bureau because you have not communicated with them about your situation. Many creditors, many loan providers, many service providers have different programs and plans in place that they can help work you into without making negative remarks to the credit bureaus about your payment default. And then if you have any overdue payments, past due payments, pick up your phone, Call your service providers, call your creditors, and come up with a plan to pay those bills so that you can catch up as soon as possible. Tip number three is to keep your credit utilization low. So, another big factor towards your score is something called your credit utilization. And this is essentially how much of your available credit you are using. So, let's say, for example, you have a credit card that has an available line of credit of $1,000, right? That's how much your credit limit is. And you are using $500, your credit utilization is 50%. A good rule of thumb is to keep your credit utilization at 30% or below. For example, if you have a credit card with a $1,000 limit, it's a good idea to keep it if you're going to be carrying a revolving balance at $300 or below. I'm a huge fan of paying off your bill in its entirety every single month if you are able to. If you find that your balance is creeping up, make it a priority to pay down your debt as quickly as possible. A lower credit utilization rate shows lenders that you are able to manage credit appropriately, that you are not overextended, and over time, this can actually improve your credit score. By the way, if you're enjoying this video, please hit the like button, subscribe to this channel, and tell your best girlfriends about Clever Girl Finance. Also, if you are ready to take action on your financial goals and you need a guide to help you craft a customized plan for your unique personal finances, check out my Wealth Plan Workbook. It is filled with practical tools, worksheets, and checklists to help you craft your plan so that you can start to achieve your financial goals. If you haven't already stopped by our website, check out clevergirlfinance.com. We have tons of articles on our website that get updated very frequently. And you can also check out our over 30 plus completely free courses and over 40 plus completely free worksheets on our website as well. Okay, let's get back to the video. Tip number four, avoid opening too many new accounts. So, opening too many new accounts over a short period of time can cause your credit score to dip. And also, it can make you look risky to lenders because it looks like you are overextended or in dire need of credit because you're opening all these accounts at the same time or within a short period of time. So, you want to avoid opening too many accounts over a short period of time or at the same time. Each time you apply for a new line of credit, it triggers something called a hard inquiry. And this can lower your score by a few points. An inquiry here or there is not necessarily a big deal, but multiple inquiries over a short period of time can definitely negatively impact your credit score. Keep in mind that now many lenders will offer you something called a soft inquiry where they don't pull a hard inquiry of your credit score in order to determine if you're eligible for a line of credit. So, if you are trying to apply for lines of credit and you want to see if you qualify, opt for the soft inquiry first, the pre-approval, pre-assessment versus a hard inquiry. But again, you still do not want to open too many accounts over a short period of time. So if you're trying to build credit, improve credit, maintain credit, only open lines of credit if you truly need them. I am not a fan of store cards. Avoid the store cards. You do not need anything on a store card. The discount on that store card is not worth it. Be mindful of opening too many new accounts. Focus on managing your existing lines of credit, paying those debt down, paying your bills on time, and over time, you will see your score improve. Number five, keep your oldest accounts open. So, credit history length, or how long you've had a line of credit, has a significant impact on your credit score. Generally, the longer your credit history, the better your credit score. Closing old accounts might be a good idea if you don't use them. However, you will lose that history when you close out those accounts. Essentially, this will shorten your average credit history, and at the same time, this can also lower your credit score. So instead of closing your oldest accounts, consider keeping them open, especially if they have no associated annual fee that you have to pay. That way, they will continue to positively contribute to your credit history, your length of credit history, and help you maintain or build your credit score. And what you can do, depending on the type of line of credit is, for example, if it is a credit card, you can make a small purchase on it every few months and then pay it off when your bill comes to you. Just remember to monitor these accounts, to be mindful of fraud, and to prevent any unnecessary fees if you get charged any. Tip number six, check your credit report regularly for updates and progress. So finally, you want to stay on top of your credit report, your credit history, your credit score by checking your report regularly to see what updates are being made, what is being reported to the different credit bureaus from your creditors, and also to track your progress with improving your score. When you're monitoring your credit often, you're able to catch errors quickly, errors that have been reported by mistake from your creditors, and also anything associated to fraud. You want to be able to catch that as quickly as possible because it can be a nightmare to deal with. Many banks and credit cards offer free monitoring tools, so you definitely want to take advantage of those because they can be very useful in helping you stay on top of your credit. And checking your credit report isn't just about spotting errors, it is a great way to see the progress you're making with paying down your debt and watching your score improve as well. Seeing your score go up, even if it's just by a few points, can be incredibly motivating, especially as you pursue your financial goals of paying down debt. And so it's important to keep an eye on your credit so that you can see how you're doing, track your progress, see what updates have been made, and stay focused on your credit building goals. So there you have it. Those are my 6 simple tips to help you boost your credit score over time. And you just want to stay focused and stick to them, especially with paying your bills on time, making sure that you're monitoring your credit, making sure that you're not opening too many new accounts at the same time, and etc. Improving your credit doesn't happen overnight, but with consistency, you will start to see progress with your score. So I would love to know in the comments which one of these credit boosting tips have you tried or will you be trying shortly? Share in the comments. Don't forget to like and subscribe to this channel. Tell your best girlfriends about Clever Girl Finance. Stop by our website, check out my wealth plan workbook, and I will talk to you next time.